Hi students, Olevels Online presents the video lecture series for other adjustments of financial statements. In this video, we will discuss the net realizable value of inventory valuation method. This video series is helpful for those students who are appearing in Cambridge O-Level upcoming exams, either in June or November, through CAIE or IGCSE or IGCSE, 9-1, for accounting 7707, or 0452 or 0985. Let's begin with the lesson material. What is NRV? The lower of cost or net realizable value inventory method is an accounting principle used to ensure that inventory is reported on the balance sheet at the lower of its historical cost or its net realizable value. This method aligns with the conservative approach in accounting, which aims to avoid overstatement of assets and income. Let's check its key concept. There are two major concepts involved in it. The first one is cost. This is the historical cost of acquiring or producing the inventory, including all costs necessary to bring the inventory to its current location and condition. It encompasses purchase cost, conversion costs, and other costs incurred in bringing the inventory to its present location and condition. Second one is net realizable value. This is the estimated selling price, in the ordinary course of business, minus the estimated costs of completion, and the estimated costs necessary to make the sale. NRV represents the amount that the company expects to realize from the sale of the inventory. Let's check its application. The first point of application is determining cost. Students need to understand how to determine the cost of inventory. This includes knowing how to calculate purchase costs, handling costs, and any other costs associated with getting the inventory ready for sale. Second point is estimating net realizable value. Students should know how to estimate the net realizable value by considering the expected selling price and deducting any costs related to the sale, such as marketing, distribution, or completion costs. Third one is comparison. NRV rule requires comparing the cost of each inventory item, or group of similar items to its net realizable value. The inventory is then recorded at the lower of these two amounts. Fourth point is adjusting inventory values. If the net realizable value is lower than the cost, the inventory value must be written down to reflect the net realizable value. This ensures that the inventory is not overstated on the balance sheet. Let's check its example. Assume a company has an inventory item with a historical cost of $100. Due to market conditions, the estimated selling price of this item is now $90, and the cost to sell it is $10. The net realizable value would be net realizable value equals selling price minus cost to sell. $90 minus $10 equals $80. Since the net realizable value $80 is lower than the historical cost $100, the inventory item would be reported on the balance sheet at $80. Let's check its importance. The importance have 3 points to discuss. The first one is prevent overstatement of assets. By applying lower of cost or net realizable value, companies ensure that their inventory is not reported at an amount higher than what is expected to be realized from its sale. Second point is reflect economic reality. This method helps in reflecting the true economic value of the inventory on the financial statements because of NRV. Third point is compliance with accounting standards. It adheres to accounting standards such as the International Financial Reporting Standards and generally accepted accounting principles. Let's check its advantages. We will discuss 3 advantages and sub-advantages too. The first one is conservatism principle. In this advantage we have further 2 subpoints. The first point in it is reduces overstatement of assets. By valuing inventory at the lower of cost or net realizable value, the LCNRV method prevents the overstatement of assets on the balance sheet. This conservative approach ensures that inventory is not recorded at a value higher than what can be realized from its sale. Second point is prudent financial reporting. This method aligns with the conservative accounting principle, promoting prudent financial reporting and safeguarding against potential losses that could arise from overvaluing inventory. The second advantage is, reflect market conditions. In this advantage we have a further two subpoints. The first point is, current market value. The lower of cost or net realizable value method takes into account current market conditions, adjusting inventory values to reflect declines in market prices. This ensures that the financial statements provide a more accurate representation of the company's financial position. The second subpoint is, relevance. By incorporating market conditions, the method ensures that the inventory values reported are relevant and up-to-date, enhancing the usefulness of the financial statements for decision-making. The advantage is, alignment with accounting standards. In this we have a further two subpoints. The first one is, compliance. The lower of cost or net realizable value method is in accordance with accounting standards such as IFRS and GAAP, ensuring that companies adhere to widely accepted accounting principles. Secondly, standardization. Using lower of cost or net realizable value method promotes consistency and standardization in inventory valuation, making it easier for investors, analysts, and other stakeholders to compare financial statements across different companies. Let's check its disadvantages. In this slide, we will discuss three disadvantages and related subpoints too. The first disadvantage is, complexity in calculation. In this we have a further two subpoints. The first one is, estimation challenges. Determining the net realizable value can be complex and requires estimates of selling prices and costs to sell, which may be subjective and prone to error. The second point is, frequent reassessment. The need to continually reassess the net realizable value can add to the complexity and administrative burden, especially for companies with large and diverse inventories. The second disadvantage is, potential for conservative bias. In this we have a further two subpoints. The first one is, understatement of assets. While the conservative approach helps prevent overstatement, it may also lead to the understatement of inventory values, potentially undervaluing the company's assets and affecting financial ratios. The second point is, impact on profitability. Writing down inventory to net realizable value can reduce reported profits, which may not always reflect the company's long-term profitability, especially if market conditions improve later. The third disadvantage is market fluctuations. In this we have a further two subpoints. The first one is, volatility. Inventory values can be more volatile under the lower of cost or net realizable value method due to frequent changes in market prices, which can lead to fluctuating financial results and make it difficult for stakeholders to predict future performance. Secondly, reaction to short-term changes. The method may cause companies to react to short-term market fluctuations, leading to frequent adjustments that might not align with the long-term view of the business. Let's check its impact on financial statements. In this slide we will discuss the net realizable value of inventory valuation method's impact on financial statements. First, on the balance sheet. In balance sheet there are two items affected due to NRV method of inventory valuation. The first item is inventory valuation. The first point is, lower asset value. When the net realizable value of inventory is lower than its historical cost, the inventory is written down to its net realizable value. This results in a lower reported value for inventory on the balance sheet, reducing the total current assets. Secondly, more accurate valuation. The use of NRV ensures that the inventory is valued at an amount that is expected to be realized from its sale, providing a more realistic view of the company's assets. The second item in balance sheet is total assets. Reduction in total assets. A decrease in the inventory value due to the application of NRV leads to a reduction in the total assets of the company. This affects financial ratios such as the current ratio and the quick ratio, which measure the company's liquidity. Let's check income statements. In this slide we will discuss the net realizable value of inventory valuation method's impact on income statement. In income statement there are two items affected due to NRV method of inventory valuation. The first item is cost of goods sold. In this we have further two subpoints to discuss. The first one is, increased cost of goods sold. when inventory is written down to its NRV, the write-down amount is added to the cost of goods sold. This increases the cost of goods sold, reducing the gross profit. The second point is matching principle. The write-down reflects a loss in the period when the decrease in value occurs, adhering to the matching principle by matching expenses to the period in which they are incurred. The second item in the income statement is net income. In this point we have a further two sub-points to discuss. The first one is reduced net income. The increase in cost of goods sold due to the inventory write-down reduces the company's gross profit and, consequently, the net income. This lower net income reflects the reduced profitability due to the decline in the value of inventory. Secondly, tax implications. Lower net income may result in lower taxable income, potentially reducing the company's tax liability. Let's check the impact on financial ratios too. The effect of NRV is also observed on financial ratios. The first category is liquidity ratio. In this category we have two ratios to discuss. The first one is current ratio. Since inventory is part of current assets, a reduction in inventory value decreases the current ratio, indicating a potential decrease in liquidity. Further, the second ratio is quick ratio. Although inventory is excluded from the quick ratio, frequent or significant write-downs may indicate broader operational issues that could impact overall liquidity. The second category is profitability ratios. In this category we have two ratios to discuss. The first one is gross profit margin. Increased cost of goods sold reduces the gross profit margin, impacting the assessment of the company's core profitability. Further, the second ratio is net profit margin. Lower net income results in a reduced net profit margin, affecting the overall profitability analysis. The third category is asset turnover ratio. In this category we have two ratios to discuss. The first one is inventory turnover. A lower inventory value can increase the inventory turnover ratio, potentially indicating more efficient inventory management, but it may also reflect a forced sale at lower prices. Further, the second ratio is total asset turnover. Reduction in total assets, due to lower inventory values, can increase the total asset turnover ratio, suggesting higher efficiency in using assets to generate sales. Let's move to another slide. Positively, you got the clear understanding of the net realizable value of inventory valuations, and related explanation as per your syllabus and examination point of view. If you have any query regarding the lesson, kindly ask in the comment section of this video. We will discuss the perpetual and periodic inventory valuation systems in the upcoming video. You can download the related formats and lesson material through the link provided below. Thank you for watching. I hope you learned something new today. If you did, like and share video with other people to learn from it. And please subscribe my channel if you want to see more videos like this. Take care of yourselves. I'll see you in the next lesson. Goodbye.